On Point with Craig's Investment Partners.
The information provided here is general in nature. It's not financial advice. It doesn't take into account your financial situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. So before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services in that regard, you can go to our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics, including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets.
G'day team, yes, it's that time again. They roll around pretty quickly these days, don't they? Let's talk about what happened last week across financial markets and then what we need to be keeping an eye on in the days ahead. Global share markets, bit of a mixed bag. The US market off 0.5%, same with the UK. Europe was down slightly less than that, down 0.4%, Aussie down 0.3%. Emerging market equities fell harder than most. Emerging markets were down 3.1% last week. Japan was really the only major market that rose. It was up 1.1%. But the local NZX 50 did have a good week. We were stronger than most markets, up 0.7%. I think that came on the back of a few good results. You had solid results from Fisher & Paykel Healthcare, from Mainfreight, a good update from Fonterra. Also some good news for the electricity sector late in the week with confirmation that the TY Point aluminium smelter down in Bluff will be staying put for the next 20 years. That gives a bit of certainty to the sector. It means they can make decisions and plan ahead, and the electricity companies listed on the stock exchange responded very positively to that. Good for the Southland economy too. Obviously that's a really important part of the local economy, and there are a lot of jobs at stake if TY Point was to go. But they're staying put for the next 20 years, so that is great news across the board. Interest rates last week, little change. The US 2-year Treasury yield fell to 4.9%. It's only down very marginally. The 10-year yield rose ever so slightly to 4.5%. Here in New Zealand, the 5-year swap rate was up just slightly, finished the week at about 4.6%. So budget 2024 came and went without fanfare. And looking back at the key events of last week, this probably was the one that markets were looking ahead to. No major surprises. Tax relief, obviously at the centrepiece of this, as you'd expect, and the National Party campaigned on tax relief. They just moved the tax brackets. So it wasn't tax cuts in a big way, it was the moving of the thresholds. And if you go and look on the online calculator and type in all your numbers, you'll find that the numbers aren't big. You're not going to get a whole lot more money in your pocket than you had before. These come into effect in late July. So I don't think they'll move the dial in a big way. But thinking about those tax thresholds, interesting to see that they haven't been moved since 2010. So it's been 14 years. And when you consider the fact that inflation between 2010 and now has increased 43%, I think it was when I calculated it. That is how much the typical basket of goods costs compared to what it did then, up more than 40%. Of course, the government should be moving those thresholds, in my opinion. You know, as each year passes by, they're essentially taxing us more, aren't they, when they don't move those thresholds? And when you're in a high inflation environment, as we have been, that impacts people even more than usual. So I think that's fair enough, although it did get some bad press because you could argue quite easily that they are funding that with borrowing, but we won't go down that rabbit hole today. Thinking about the forecasts from the Treasury, they're a little more cautious than we've seen from others, certainly a bit more cautious than we've seen from the Reserve Bank. So they do reflect a more challenged economy, a lower tax take, more frugal spending ahead. The Treasury does see inflation coming down more quickly than the Reserve Bank, but that's because I think they see unemployment rising further. So they've got the official cash rate actually falling before the end of this year, which is where financial markets are at too. Financial markets still see the OCR is likely to rise in about November. Current pricing points to about an 80% chance. So there wasn't a whole lot of movement there from the market in the wake of the budget, and I think what that tells you is that in the eyes of market participants at least, there was nothing in here to suggest that this budget will be inflationary in a big way. Nothing that will really move the dial for the Reserve Bank and cause them to think, oh, geez, this has changed the landscape. We might need to raise the OCR even more. We might need to hold it where it is for even longer. Nothing of that nature. The market reaction was very limited, which suggests that there is probably nothing of major concern from an inflation or Reserve Bank perspective. We also had business confidence last week. The ANZ Business Outlook survey for May was out, and as I expected it to, headline confidence did fall further. It came down from 14.9 to 11.2. That's the fourth consecutive monthly decline, and business confidence in New Zealand is now at the lowest level since September last year. So it's back to where it was pre-election. That bump you had around the time of the election with businesses hopeful that a change of government might make their lives easier, that sort of has dissipated. And I don't think there's any reflection on the government. I think it's just the reality setting in that we are in a very tough environment, and some of the challenges that we face as a country, as an economy, won't be easy to fix, even for this new government who has come in with some fresh ideas. More encouragingly, inflation expectations fell. So they came down from 3.8 to 3.6. That's good, moving in the right direction. And the proportion of firms that are expecting to raise prices fell slightly, came down to just below 42%. So that's the lowest in a little over 3 years. So that is positive. At least you've got inflation indicators that are softening a little bit, even though you've got confidence that is reflecting a very difficult environment out there. Internationally, the biggest release was the PCE inflation report, personal consumption expenditures, and this came out on Friday night in the US, so we didn't get it until Saturday here in New Zealand. The headline PCE rose 0.3% for the month, the core PCE up 0.2% for the month. Those were in line with forecasts, and that sees the annual rates of growth unchanged from where they were in March. So the headline is increasing at 2.7% per annum, and the core inflation measure from the survey at 2.8%. So in the mid to high twos. As the Federal Reserve's preferred inflation measure, this is closely watched, and we saw this consumer price index a couple of weeks back come in marginally below expectations, so this has confirmed that things are tracking as expected. So a piece of good news, 2.7, 2.8, still probably a little higher than where the Fed wants it to be. They'd rather it be closer to 2 than closer to 3, but after that string of hotter than expected releases we saw earlier in the year, I think they'll be quite comfortable with that. The Federal Reserve actually meets next week, so we don't have to wait very long to hear from them again. You won't get any change to policy settings next week. The Fed funds rate is at 5.5%, and that's where it will stay. But we will be very interested in a new set of economic and financial projections that will come out at that meeting. So we haven't seen one of those since March. So 3 months has passed and a few things have changed, and we'll be all very keen to see what the Fed thinks about the future. At the moment, markets see a 60% chance of a Fed rate cut in September, and those odds rise to almost 90% by November. So very similar to what you're seeing here in New Zealand. Right, turning to the week ahead, what do we need to be keeping an eye on? Starting internationally, politics will actually be in the spotlight this week. Mexico held a presidential election this weekend, so we'll be awaiting the results of that early in the week. There's also elections for the European Parliament, and those are held, I think, from Thursday through to Sunday this week and through the weekend, so that's on the radar. And India as well is coming to the end of its 6-week-long national election process. So voting concluded on Saturday, and markets are awaiting the verdict, which is scheduled for Tuesday. Current Prime Minister Modi and his party, the BJP party, are expected to secure another term, and if they get a stronger majority than they did in 2019, that could be a positive for financial markets in India. A lot of people think that that could be taken well, as it could mean we will see some more growth-focused policy initiatives. So a bit of politics to keep an eye on in some parts of the world. Looking at the economic calendar, it'll be quite a busy week in the US. We will have the ISM indices for May, the Institute of Supply Management indices, one for the manufacturing sector, which is out on Monday, and one for the services sector, which is out on Wednesday. There's also the jobs report in the US, and this will be very closely watched when it comes out on Friday. It'll cover the month of May. It's the last big economic release before that Federal Reserve meeting next week. And with the labour market such a crucial piece of the puzzle when it comes to inflation and central bank policy in places like the United States, this will be very closely watched by investors. The jobs report was a bit weaker than expected last month, and that did give markets hope that the US economy isn't overheating and that the Fed will still be able to reduce interest rates later this year. So I think markets will be wanting this month's release, to be in that sweet spot again. Not too hot, but also not too cold. So what they're expecting this week is 190,000 new jobs to have been created, which will be a little above last month. It was 175 last month, and that's good enough to keep things ticking over, but it's not super strong, 190,000 a month. And for the unemployment rate, markets expect it to remain unchanged at 3.9%, which, like New Zealand, that has risen from the lows that we saw over the last year or two, but it's certainly below that long-term average. So it's rising, but it's not rising too much. And I think wage growth will be in focus as well. Wage growth last month was more subdued than expected, and we saw average hourly earnings rise at an annual rate of 3.9%. And that's actually the first time in 3 years that it's fallen under that 4% level. So markets will be looking for more of the same, and those will be the key releases on the economic calendar, at least internationally. The ISM indices on Monday and on Wednesday, and then that jobs report in the US on Friday, so we won't get it until Saturday morning. The ECB will be in focus too, the European Central Bank, and they could be the first of the major central banks to cut interest rates, and that interest rate cut could come this week. The ECB meets overnight on Thursday, and markets believe there's a pretty good chance that we will see a 0.25% rate cut. The ECB's policy rate is at 4%. That's the highest since the euro came into being in the late 1990s. It's been there since September last year. And Europe has seen some pretty good progress on inflation over the last little while. We had an inflation report last week. Ironically, it actually did come in a little hotter than expected, but only marginally. It came in at 2.6% in terms of the annual change. The market was expecting 2.5%, so only up ever so slightly. But when you consider that European inflation was almost 11% back in 2022, 2.6% represents very good progress. So markets still see more rate cuts in Europe than they do in other regions, 3, maybe 4 over the coming 12 months. That's more than people are expecting from a lot of other places, and we might see the first of those this week on Thursday. So that will be very closely watched. Here in New Zealand, obviously a holiday shortened week, and there isn't a whole lot on the calendar. We have got a dairy auction though on Wednesday, and the agricultural sector will be hoping for more of the same. A fortnight ago we saw a nice rise, the headline dairy price up 3.3%. That was the fourth auction in a row where things rose, and it was the strongest gain since February. So the GDT index, the Global Dairy Trade Index, is up 11.5% this year. It's actually at the highest level since late 2022, and the backdrop is pretty good for the new season for farmers. So Fonterra provided a business update last week, quite good in terms of what's happening within their business, but it was also very pleasing that Fonterra maintained its current season payout for the 2023-2024 season, which is just ending at $7.80, and it also announced an opening forecast for the upcoming season, the 2024-2025 season, that has a midpoint of $8. So that would be the fourth highest in Fonterra's history, and it would be a nice uplift from what we saw in the season that is just finishing. Still very early days, so I think Fonterra has been a little bit cautious there. A lot of the economists see the upcoming season in the mid-8s rather than as low as 8, but I think you would be cautious, especially what we've seen over the last year or two in commodity markets. And remember what happened last August. You saw dairy prices slump quite dramatically, so they won't want to go out and overpromise. They would prefer to play it safe, I suspect. So that will be on Wednesday morning, and that will be of interest. Elsewhere, things to keep an eye on. In China, we've got a couple of PMIs, a manufacturing PMI out on Monday afternoon, a services PMI out on Wednesday. We had the official releases last week and they didn't look particularly encouraging, so we'll see if these ones that are coming up this week paint a more positive picture. Across the Tasman, the highlight will be March quarter GDP figures. These are out on Wednesday afternoon, State of Origin that night, so make sure you stay up late for that one. And on the corporate front, it is actually quite a quiet week. There is nothing across the Tasman on my calendar, at least. Here in New Zealand, all I've got written down is a Scales annual meeting on Wednesday. That could be interesting. You might get a bit of a trading update from Scales, and internationally, Dollar Tree and Lululemon on Wednesday. But other than that, that is us. That is how the week is shaping up. So hopefully that's useful. Always good to chat. We will talk again soon.
For more insights, visit craigsip.com.